Across the UK, homeowners are bracing for a financial shock. It's a situation that's been brewing quietly, but the alarm bells are starting to sound. This is the story of a mortgage time bomb, a looming crisis that could shake the very foundations of homeownership in Britain. As we delve deeper into this issue, we'll be looking at the factors contributing to this predicament and the potential fallout. So without further ado, let's uncover the factors at play and what it could mean for millions. To understand the looming crisis, we first need to look at the mortgage landscape in the UK. The mortgage market is a vast and complex network where banks and other financial institutions lend money to individuals and businesses looking to purchase property. This money, usually lent over a long period of time, is paid back with interest, forming the backbone of the housing market. Over the past decade, the UK mortgage market has been characterised by low interest rates. The Bank of England, the institution responsible for setting the country's interest rates, has kept them at historically low levels since the financial crisis of 2008. This has made borrowing money cheaper than ever before, leading to an increase in the number of mortgages being taken out. Low interest rates have allowed homeowners to secure affordable borrowing costs, making the dream of owning a home possible for many. These low rates have also fueled a boom in property prices, with the average house price in the UK reaching an all-time high. However, with every silver lining, there's a cloud. The flip side of low interest rates is that they've encouraged many people to take on large amounts of debt. This debt, in the form of mortgages, is manageable while interest rates remain low. But what happens when they start to rise? Interest rates are influenced by a variety of factors, including the health of the economy. When the economy is strong, interest rates tend to rise, and when it's weak, they tend to fall. For the past several years, the UK's economy has been relatively strong, leading many to speculate that a rise in interest rates could be on the horizon. This brings us to the crux of the issue. If interest rates rise, the cost of borrowing increases. This means that homeowners with variable rate mortgages could see their monthly payments go up. For those who are already stretched thin, this could lead to financial difficulties. But as the economic climate shifts, so too does the stability of these loans. The mortgage market, like any other financial market, is not immune to change. It's a dynamic, ever-evolving environment that requires constant vigilance and careful management. And as we move forward, the ability to navigate this market will be more important than ever. Recent years have seen dramatic economic events, from Brexit uncertainties to global pandemics impacting financial markets. Let's dive a little deeper into these factors and how they've contributed to the potential mortgage crisis. Firstly, we have Brexit. The decision to leave the European Union sent shockwaves through the UK economy, causing a period of uncertainty that touched every sector, including housing. The ripple effects of this decision have been far-reaching, and the housing market was not spared from these impacts. The economic instability resulting from Brexit has made it harder for banks to predict the future and set interest rates accordingly. Secondly, let's talk about the global pandemic. COVID-19 has had a profound impact on the world economy, and the UK has been no exception. The pandemic has triggered an economic slowdown, with thousands of people losing their jobs and businesses shuttering their doors. This has led to a decrease in consumer spending and a subsequent drop in economic growth. The reduced economic activity has put pressure on the Bank of England to keep interest rates low to encourage spending and investment. However, this brings us to our third point, the potential for interest rate hikes. While low interest rates have been a lifeline for many during the economic downturn, they can't stay low forever. As the economy begins to recover, the Bank of England may need to raise interest rates to keep inflation in check. A hike in interest rates would mean higher borrowing costs, which could put additional financial strain on homeowners with variable or tracker mortgages. In conclusion, the combination of Brexit-induced economic uncertainty, the economic fallout of the global pandemic, and the potential for rising interest rates have created a perfect storm of economic factors contributing to the looming mortgage crisis. Now, with inflation on the rise, the Bank of England is in a position where it might have to hike interest rates to stabilize the economy. What does this mean for the average homeowner? A question that is undoubtedly echoing across the nation as we speak. As interest rates begin to climb, the cost of variable and tracker mortgages will inevitably follow suit. This might not sound like much at first, but let's put it into perspective. Consider a homeowner who has a variable mortgage. When interest rates were low, this homeowner enjoyed relatively small monthly payments. But as rates rise, so too will these payments. And not just by a few pounds. For some, it could be hundreds of pounds more each month. Now multiply that by the millions of homeowners across the UK who are in the same boat. Suddenly the magnitude of the issue comes into focus. We're not just talking about a few isolated cases. We're talking about a potential financial strain that could impact a substantial portion of the population. But the pinch doesn't stop there. It's not just about the mortgage payments, it's about the overall household budget. Many families are already feeling the squeeze from rising living costs. Food, utilities, transportation, healthcare. The cost of virtually everything is going up. So now imagine that on top of all these escalating expenses, you also have to contend with a significantly higher mortgage payment. It's like a financial 1-2 punch that could leave many families struggling to keep up. The impact of this mortgage time bomb could reverberate beyond individual households. It could affect the broader economy as well. When people are spending more on their mortgages, they have less to spend elsewhere. This could lead to decreased consumer spending, which in turn could slow economic growth. And let's not forget about the psychological impact. The stress and anxiety of dealing with financial uncertainty can take a toll on people's mental health and overall well-being. So, you see, the repercussions of this looming mortgage crisis are far-reaching. It's not just a matter of higher monthly payments. It's about the potential for widespread financial strain and the ripple effects that could have on households and the economy. This could lead to increased monthly payments for millions, squeezing household budgets that are already tight from rising living costs. Facing this mortgage time bomb, there are ways homeowners can prepare. The key is to be proactive and informed. It's not a time for panic, but for strategic thinking and decisive action. Let's explore some potential solutions. One of the most effective methods to counterbalance the rising interest rates is refinancing your mortgage. If you're currently on a variable or tracker mortgage, you're directly exposed to the fluctuations of the interest rates. In this scenario, switching to a fixed-rate mortgage could be a wise move. This will allow you to lock in the current rates before they climb further. It's like securing your seat in a lifeboat while the ship is still afloat. Of course, refinancing is not a one-size-fits-all solution. It's crucial to consider the costs associated with it. These may include early repayment charges on your current mortgage and arrangement fees on the new one. It's a balancing act between these costs and the potential savings from a lower interest rate. Another approach is to overpay your mortgage if your lender allows it. Paying more than your regular monthly payment can help reduce the overall amount of debt and shorten the mortgage term. This can save you a substantial amount in interest over time. Remember, financial planning is not just about your mortgage. It's about your overall financial health. Review your budget, cut back on non-essential spending, and build up a rainy day fund if you haven't yet. This will provide a safety net in case of unexpected expenses or income loss. Lastly, don't hesitate to seek professional financial advice. An advisor can provide a personalized plan based on your unique circumstances and goals. They can help navigate the complex world of mortgages and guide you towards the best course of action. These are challenging times indeed, but with the right strategies and support, homeowners can weather the storm. Refinancing to a fixed-rate mortgage might be a viable strategy for some, locking in current rates before they rise further. While the situation is daunting, understanding your options and planning ahead can help mitigate the impact of this mortgage time bomb. We've delved into the complexities of the shifting mortgage landscape in the UK, explored the economic factors that have set the stage for this crisis, and examined the potential fallout for homeowners. The key takeaway here? Staying informed is vital. The financial world is dynamic and ever-changing. The more you know, the better you can navigate the challenges that lie ahead. And remember, you don't have to face this alone. There are professionals who specialize in this field, ready to guide you through your financial journey. Whether it's refinancing to a fixed-rate mortgage, adjusting your budget, or devising a more comprehensive financial plan, there are strategies that can help you weather this storm. It's crucial for homeowners to stay informed and seek advice from financial experts.